So we've got what they call capital gains. So capital gains is triggered if you literally sell, right? If you sell something, right, a capital asset, you trigger capital gains, okay? Meaning to say, SARS wants to tax you on the gain that you made from the capital asset, from selling, disposing the capital asset. Sometimes you might not have sold it literally, but you might have been deemed to have disposed. Like in this situation, they are deeming you disposed. Why? Because you received compensation from the insurance company as a result of a loss of that asset. So it's a deemed disposal. So that triggers capital gains. So SARS wants to tax the gain on the capital asset. All right. So it's the steps that you know, right? We'll get a day where we're just doing capital gains, but not for Monday. Okay, where we're strictly doing capital gains on its own. But for the sake of, because now they merge this to the capital allowance questions, right? Like this one. So this is how you do it. I think this you know, right? Where we say what? Cost minus what? Accumulated allowances. Okay, you get the tax value, right? We are aware of this stage, right?
Yes.
There we said cost minus accumulated allowances, right? We got the tax value. There we go. Right? The next step, we said what? You are aware of this stage as well. Selling price limited to cost price. Less tax value. You've got your what? Recoupment. We are aware of what? The stage. Selling price limited to cost price, less tax value. This you know, these two. But the one that might not be familiar, but you know this because you did this in second level. All right, there's no difference at all. Okay, so here we are saying now the selling price without any adjustments, like the selling price as it is. Right, no limited to, just selling price. So these are the steps that you need to follow. So this you know, right? This gives you tax value. Second step, always these steps, 1, 2, 3. That's why I wrote them in that order, 1, 2, 3. Don't change or try shortcuts. Follow that order. Step 1, cost minus accumulated allowances gives you the tax value. That tax value that you used it in what? In step 2. That's why you need to follow that sequence. Selling price limited to cost, you get the lesser between the selling price and the cost price. Then minus the tax value, you get your recoupment. Then step 3, you might not be familiar with, or you might have forgot. You take the selling price as is, you less the recoupment that you got there. You get what they call the adjusted proceeds. Right? So in other words, you are adjusting your proceeds because your selling price has been adjusted by what you recoup. Because remember, we are saying from the selling price, there's a certain portion that you paid back. So what you do, you reduce the selling price with the recoupment, then you call that figure adjusted proceeds. You have adjusted the original selling price by removing what you recouped to SARS. Okay, so let's go to the solution. So you remember the recoupment, there it is. So you always perform this at the end, right? That's why I say selling price minus recoupment. I get my adjusted proceeds. There you go. So you wait until the end of the question, until you're done with all the adjustments given by the lecturer. Then you come and do your capital gains calculation. Okay. Then when you're done with that, you take your adjusted proceeds and then you come and calculate your gain. All right. So these notes are just in case there's 2 assets. All right. So you do for asset 1, you do for asset 2. So you come and feed the adjusted proceeds that you got here. Then you less the what? The base cost. So the base cost is your total, in other words, is your total cost that you incurred on the asset. When you bought the asset, maybe you improved the asset. Okay. So the other rules that I won't tell you now, but I'll just show you. Right. It says here, right, base cost of asset acquired after 1 October 2001. So I don't want to dwell much on this because I need a day to just explain capital gains on its own. All right. But just know that as long as the asset was acquired after 1 October, as long as the asset was acquired, like literally bought after 1 October. Okay. So let's go to our question. Right. When was this asset bought? Everyone? To May 2022. It's after 1 October 2001, is it not? So I say, as long as the asset was acquired, right? So it's based on the date, like scenario date. This one was acquired on 2 May 2022. So it's after 1 October 2001. So the base cost to be used for calculating the capital gain will be the tax value that you calculated plus cost incurred. Like if the question throws improvement costs, valuation fees, agent fees, legal fees, you add it to the tax value. That becomes your base cost. Okay. Then you take that base cost and plug it here. Then you say adjusted proceeds less base costs. You get your capital gain. Okay. So that's your capital gain. Right? It's a normal sale, right? You had a car, right? That cost this much. You sold it for this much. You gained this much. That's capital gain. You had a machine that you're using at the farm. You no longer want it because it is giving you problems. It cost you this much. You sold it for more than its cost. That's capital gain. All right. But SARS says, okay, from what you gained when you sold the asset, we don't tax everything. No, we only want to tax 80% of what you received. That's why we call it, that's why you always see in your FAC questions, capital gains 80%, 80%. It's a rule to say whatever you gained, 80% is what you include in your calculation of your taxable income. So 80% of what you gained is subject to taxation, not 100%, but 80%. That's why you always see in your FAC 80% capital gains, 80% capital gains. That's where that comes from. All right. So now that I've explained that, there is our gain. So I use the base cost. So I use the tax value, if you see, because this was an asset acquired after 1 October. So it was base cost. We didn't have any other costs like improvement, valuation fees, whatever. So I just took the base cost. So or the tax value was used. Subtract that, you get your capital gains. Then we are saying that on our capital gains, we only include in our calculation how much? 80%. So 80% of that is what will be subject to taxation. But remember, you go back to SARS. SARS says, okay, if voluntarily you had to what? Get rid of this asset. So you do not budget for what? For any capital gains. Because if things were normal, you're not going to have this transaction of capital gains. All right. So SARS says, okay, also because we also tax the capital gain, you can also defer it. In other words, you can also what? Include it in your what? In your taxable income, like your recoupment. That is the story. I'm just trying to explain so that it makes sense. So I don't make you cram when this thing comes. The explanation is because of the involuntary sale of something, you're not expecting capital gains in your calculations. But because of the unforeseen circumstances, you're hijacked. So you have to replace with another asset. So that triggers deemed disposal, and deemed disposal triggers capital gains. Pasar says, okay, don't include the full what? 102, because that will increase your taxable income. But from that, using the allowance, right, of the new asset that you bought, the new truck, 6 years divided by, so multiply by 3 months over 12. So that's the portion you can include in the current year. And for the coming 5 years and 9 months, you'll be including capital gains in portion. So next year, you're going to include what? 6 years multiplied by 12 over 12, because it's for the full 12 months. The next year, just like that, 6 years multiplied by 12 over 12 until you exhaust the 102. So this deferral only happens through involuntary what? Disposal of the asset. Then you only include that portion in the current year. But if there was no deferral, you're going to include in the final column the 102. If there was no deferral, take this full amount and SARS taxes it. Then, so that is the end of your calculation. Then your taxable income, 35 marks. Okay, so I deliberately left out, I think I saw an assessed loss. Right, you see? So there is the paragraph 65. Right, election. It's about deferring. This applies to capital gains. So normally with this one, how would you have dealt with that? You would have come here and said capital gains, you would have said less capital allowance, capital loss of how much? 11,000, right? Then you get a new figure here, right? Then you say 80% of that, you get that. Then 6 multiplied by 3 over 12, you get the amount to include. So you subtract the capital allowance. Capital loss, sorry, it's a loss from last year. So it reduces the gain that you made in the current year. All right. So by principle, that is what happens. So if they give you the loss, as they did here, you come and subtract it because it's a loss. So it reduces your gain so that you are taxed on a less. Remember, taxation is about you paying less. So you use losses in the current year to reduce what you're supposed to be taxed. So that is what I wanted to explain. So you can then go and prepare for the Monday session. Go through the videos, go through exercises, and you'll be fine.